Hope my screen is visible from there.
Yes, yes, go ahead.
Yes.
Thank you. So let's get started. Okay, let's imagine a scenario where your statement of financial position truly reflects your organizational financial commitments. IFRS 16 does just that. It transforms the presentation of leases, providing a clearer picture of an entity financial health. So let's meet Sarah, the CFO of Simwest, a big retail company with stores in different countries, all renting their rental spaces through lease agreements. Before the implementation of IFRS 16, Simwest financial statement did not fully reflect the company's lease obligation, which is duration of lease, rental payments, renewal options, and other obligations. The leases were treated as an operating expenses, and the associated liability were disclosed in the note to the account, frequently overlooked by the shareholders. However, when IFRS 16 was introduced, Sarah saw an opportunity to bring greater transparency to Simwest. This standard outlines how organizations should account for their leases by requiring the lessee to recognize assets and liability related to the most lease on their balance sheets, now giving the shareholders a clearer picture of the company's financial health. So thanks to the changing power of IFRS 16. The only thing worse than change is no change. The world will keep changing, and so must we. Let's embrace IFRS 16 as a tool for better financial transparency. So good afternoon, everyone. My name is Oluwatobi Okoma. I will be your guide through this training section. Oluwatobi will be your trainer for the next hours. And I'm excited to be here again. And a big thanks to everyone for joining today. My chief host Chima Christy, thanks for participating. My Oga, thank you very much for participating. And your participation is greatly appreciated. So if you have any questions to ask during the section, please feel free to use the chat box. All questions will be attended to after the training. So thank you all. So let's begin. Oh, my slide is changing over there.
Yes, please. Yes.
Okay, thank you.
You're on table of contents.
All right. Guiding you through this section, we are going to have a brief recap of the overview of IFRS. For those that are not in our first class, we are going to have a brief recap of IFRS. Its objective, the key standards that affect financial statements, introduction and components of IFRS 16, lease, sales and leaseback transaction. And we are going to be looking at the audit of lease liability and right-of-use assets. And at the end of it, so we are going to have a practical illustration to demonstrate all the contents of IFRS 16. And by the end of this training section, you will all have a comprehensive understanding of what leases are and its components. So the overview of IFRS. The overview of IFRS. IFRS, International Financial Reporting Standard, is a set of accounting standards developed and maintained by IASB, that is, International Accounting Standard Board. IFRS is based on a set of principles rather than the specific gap, that's the usual gap. This allows it to be what? To be flexible and transparent in financial reporting. So some companies, especially public quoted companies, are mandated to follow this principle, that is IFRS. So the key example of this standard are IFRS 9, which is financial instruments, IFRS 15, which is revenue from contracts with customer, and IFRS 16, leases, which we are going to look into in details in today's training. So what are its objectives? What are IFRS objectives in relation to IFRS 16? Number one, to improve transparency. To improve transparency, that is, it helps in giving a complete and clearer picture of an entity leases arrangements in the financial position. Transparency. Number two, it enhances comparability. It enhanced comparability. That is, it enables companies to compare financial performance for good performance appraiser, because when there is a uniform principle, there is a uniform standard, then to compare will be very, very easy. Most especially for investors, they will be able to know where to invest their fund. Number three is better decision making. And now that lease obligations are shown on the balance sheets, people who made use of financial statements such as investors, the creditors, can now make what? A smarter decision on lease activities. Number four of it is to address off-balance sheet financing. You know, for companies to include lease liability in their balance sheets, it helps to prevent the financials to be hidden. That is, it gives more accurate picture of company's situation. So let's briefly move to the next slide. When we talk about the challenges of this standard, anything that have advantage must surely have what? A disadvantage. So what are the key challenges to IFRS 16? Number one is complexity of standard. IFRS 16 can be so complex sometimes, most especially for industries with many leases arrangements. Industries like airlines, construction companies, logistic companies, and so on. So they might find it very difficult to track and value their numerous lease proxy. So which will require what? A solid understanding of accounting knowledge. Number two of it is data quality and integration. This means making needs a robust system to collect data from various sources. You know, sometimes it's very difficult for some organizations to collect data, most especially for companies that have different branches. For them to collect data to comply with this standard sometimes is very difficult.
We are not seeing your slide though.
Sorry, I mean challenges in achieving compliance. So I'm explaining data quality and integration now. So which one are you seeing over there?
Yeah. We are not seeing your slide, your presentation slide.
The presentation slide, nobody is seeing it. I'm not seeing it.
Okay, I'm
She's going to reshare it. I'm talking to her already.
Are you seeing it now?
No.
Yes, it's showing now.
No,
it's not showing. I don't know where you're
saying. We're not even seeing your picture. We're not even seeing you. How much?
No, you can't see
It's showing. It's showing here.
Christy may be
Challenges in
showing with
achieving
you, but we are not
compliance.
seeing it. I'm not seeing
We
it.
are
What is
not
showing
seeing it. Oh.
What I'm seeing on my own sheet is Christy 5 something. That's what I'm seeing.
Ah, no.
Okay, so sorry. We'll quickly fix it.
I think only because
Can someone confirm
Even the presenter,
that
we're
is
not
not
seeing the
seeing it?
presenter.
Chima, are you there? Chima, are you seeing my slide?
No, same here. I can't see the slide. Same here, please.
So, sorry, who else can confirm? Maybe it's the other, maybe it's your network from over there.
It's not network.
We network
Okay,
No,
present
it's
seeing
not
on slide.
network. I'm not seeing it.
I don't think it's a network issue.
It's
We
not
are not
network.
seeing the slides.
It's not
Even the
network. I'm not
presenter,
seeing
we're not
as well
seeing you.
too.
Same here also. I'm not saying the slide.
I'm not seeing as well.
But I haven't had to leave and rejoin right now. I'm still not seeing, still the same thing.
Though your presentation, your voice is audible and clear enough, but we are not seeing
the slide.
what you
The slide.
are.
Are you seeing it now? Stop and reshare again.
Still the same thing.
It's the same thing.
I can see from here.
You
I
can see.
don't know what the problem could be.
It's okay.
Oh, no,
If the
that's not
co-host can see it, then
We
let
can't
the
see it.
co-host share the slides.
Okay, all right. That'll be fine.
okay. You see, you have the slide, right? Please let me share it. Let's see from your hands.
Please stop sharing.
I have to stop sharing. Wow.
Yes, please. But you can speak to your slide.
Okay. Yes, I'll stop sharing. You can share from your hands.
It's okay
right.
now.
Wow, we are
We
seeing
can
it
see it
now.
now.
Can
It's
you see
okay
my
now.
screen?
Yes, I can see.
It's seeable
okay
now. We
now.
can see
All
it
right.
now.
You
Yeah.
can. All right, thank
But we
you.
are not seeing the
All right,
presenter,
thank
Sha.
you. So please, let's go
Yeah,
to
you
the-
won't be able to see the presenter because she's not putting on her video.
Okay.
All right, thank you.
Let me read the slides. Challenges to IFRS. That's where we have.
Sorry, is it possible that I can make a suggestion? Sorry.
Okay.
Before you continue, a lot of people that use my own link, it is showing my name in their own device. Please, can they rename their device so that we'll know who is speaking? Because there are a lot of people using Chimaro Kewaji as their display name because they just click the link and joined. Can you rename so that it will show your name so that it will not be as if I'm the one asking the questions and all that?
All right, please, do we understand what Chimaroke just said? Kindly check and rename your device to your own name. Thank you. Toby,
Yes.
please, you can have the floor.
All right, thank you.
Yes,
Okay.
sorry, please, before you continue, can you make a full show of your slideshow so that it can be visible?
Oh, dear, make for your
Christy, please mute. Christy, please mute. All right. So, hello, hope I'm still audible. Hope I'm still
Yes, we
audible.
can hear you.
Sure.
Yes, we can hear you.
Okay. All right. Thank you. So let's go ahead. Number 3, impact on IT system. A company needs to update their software to handle this new requirement, right? So making sure that the changes do not interfere with their day-to-day operations might be a major problem to them. Making changes to this standard on their software might be a challenge. Number 4 of it is resource constraint. resource constraint. Complying with the standard sometimes needs what? Both financial and human resources. And you know, small and medium scales might not be able to afford it because of the costs. Number 5 of it is transition challenges. Conversion from IAS 17 to IFRS 16 might not be also easy for SMEs because it involves training of staff on this new standard, which they might not be able to afford as well. So let's quickly go to the next slide, Christy. The next slide, please. The next slide talks about the components and key standards that affect financial statements. The components and key standards that affect financial statements. Before we talk about standards, we have to look at the financial statement because we are going to apply the standard in the financial statements. So what are the components of financial statement? Number 1 is the balance sheet, which is the statement of financial position. It shows what the company owns, which is the assets, and also what the company is owing, which is what? The liability. And what is left over for the owners is called what? The equity. So the standard that affects this component is IFRS 10, which provides guidance on consolidation of financial statements, and the IFRS 16, which addresses the recognition and measurement of leases, which we are going to look into today. So let's go to the income statement. The income statement, that is statement of profit or loss, which shows how much money the company made, which is what? The revenue, and how much it spends, that is their expenses, and whether it's ended up to be more money or less. That gives us what? Whether it's what? Net income or loss. And this is also affected by IAS 1, that is presentation of financial statements, which will be replaced by IFRS 18, that is presentation and disclosure in financial statements, effectively on or after January 2027. And we have IFRS 15, which we talk about recognition of revenue from contracts with customer, which we have already dealt with in our last class. So let's quickly go to the next slide, Christy. Cash flow statements. Which talks about the cash flow statements. Christy, are you there? Can change the slide.
I'm here. This my system can be very dramatic. I'm trying to go to the next slide.
All right.
One thing.
So the cash flow statement. All right, thank you. So the cash flow statement. The financial statement is designed to separate cash inflow and cash outflow into 3 categories. That is the operating activities that deals with the generating of activities such as sales and services, and also investing activities that relate to investment in assets like equipment or properties. When we look at the financing activities of it, is a financial transaction such as acquiring long-term assets, investment, or also for debt repayments. So IFRS, the regular IAS 7 is being affected by cash flow, and then we have IFRS 9, which is financial instrument, which we are going to talk about in our next class. So let's briefly move to the statement of equity. It includes things like transaction with shareholders, that is issuing and buying back of shares, and also changing in the company's profits that is kept, which we call retained earnings. This is also affected by what? IAS 1 and IFRS 9. While the notes to the account provide additional information and explanation about all standard presented above in the financial statement. So, such as accounting policies being used, the assumptions, and so on. And that is the reason why the note to the financial statement includes all standards that help the user to understand the financial performance and position of the organization. Let's quickly move to the main topic for today, which is leases. Leases. IFRS 16 is an accounting standard that came into effect on January 1st, 2019 to replace the previous accounting standard, which is IAS 17. Hope I'm audible enough. Hope you can hear me.
Yes, we can hear you. Go ahead.
Yes, we can hear you very well.
All right, thank you. So the story behind the change from IAS 17 to IFRS 16 can be compared to a man who met a young lady in her teen. In her teen, maybe 15, 16. They are both together for 30 years. And they had 10 children for each other, but they were not legally married. So after 30 years of being together, the man wrote his will and let out the name of this young lady from his will, claiming because they are not legally married, so she doesn't have any right to her will. This scenario illustrates how leases were treated under IAS 17, whereby companies could lease an asset for many years, 10 years, 15 years, and more, now recording such lease payments on yearly basis as an expenses and disclosing them in what? In the financial statements. Expenses and disclosing them. Okay, so now recording such lease payments on yearly basis and disclosing them as what? As an expenses in the financial statements. Under what? Under operating leases. Simply because the asset does not legally owned by the entity and could not be what? Could not be capitalized as what? As an asset. IFRS 16 says no to operating leases and states that all leases should be treated as a finance lease and requiring companies to list all their right of use assets and its liability on their balance sheet in order to provide a clearer picture of the financial performance of the entity. Hope I'm communicating.
Yes.
All right, thank you. So this approach focuses on the actual usage of lease assets rather than what? The legal ownership. Usage rather than what? The legal ownership. So let's move to the next slide, please. Definition of leases. All right, thank you. So what is leases according to IFRS 16? Leases are contracts where one party. Leases are contracts when one party, that is the lessor, the owner of the asset, allow the right to use an asset to another party, which is the lessee, that is the renter of the asset, in exchange for payments over a specific period. That is, as a tenant in the house you are living, you are the lessee, yes. While your landlord is what? Is the lessor. The office space you rented from the owner to carry out your day-to-day operations, you are the lessee. And the owner of that office space is what? Is the lessor. Now, the shop you rented from the owner to sell that your goods as an entrepreneur, you are the lessee there. Why the owner of that shop is what? Is the lessor. Growing up those days, it takes a long time for us to differentiate who is the lessee, who is the lessor. Sometimes we interchangeably, we are trying to take it one after the, who is the lessee, who is the lessor. So it takes a longer time to identify it. Hope I'm communicating.
You're enjoying.
All right, thank you.
Yes, ma, thank you.
All right. So these leases can involve various assets, such as property, equipment, vehicles, and is what is typically involve non-cancelable period. That is, that period in which you are in contract is what is not cancelable. So, in conclusion, the parties to lease agreement are what? The lessee and the lessor, right? Okay. Hope I'm communicating. Please, the next slide, Christy, please. The next slide. So, what are the exemptions to this standard? What are the exemptions to this standard? IFRS 16 applies to all leases except for certain exemptions. One, short-term lease. So these are the lease agreements for a short period, usually less than what? A year. Short period, less than what? A year. From January to December is classified as what? Short-term lease. So it's exempted from what? IFRS 16. Number two is low value assets. Item that does not cost much. These are the items that doesn't cost much. Well, there is no specific amounts, but IFRS 15 guide us and suggest that figures around 5,000 or less are classified as low value. It now depends on the policy of the organization. We can't compare MTN to any other organization. What is of low value to your company might not be low value to me. So this is what depends on what you classify as low value. Such assets that falls below the low value are what? Computers, office furniture, telephones, and so on. Christy? All right. So, any other leases that falls within the scope of other standards, any other leases aside the low value and short-term lease, any other lease arrangements that fall within the scope of other standards, such as IAS 41, biological asset, IAS 38, intangible asset, and other standards are what? Are also exempted from this standard. So let's go to the next slide. What are the key principles of IFRS 16? What are the key principles of IFRS 16? For a contract to meet the definition of lease according to IFRS 16, one, the lessee must have what? The right to control what? The use of the identifiable asset. For that what? For that period. That is, you as a tenant, you must have the control over what? Over that house you rented. You must be able to lock it at any time. You must be able to open it at any time. You must have the control for it to work. For it to qualify as what? As a lease item. Number two, the lessee must have what? The right to obtain all economic benefits from the use of what? Of these assets. All benefit that comes from that asset what? Must flow to what? To the lessee. That makes it qualify to be what? To be classified as lease assets. Number three is the lessee must have rights to direct the use of that identifiable asset. That is, you must be able to what? To direct, this is how I want to use it, this is how I want to, you must be able to direct it. So that makes it qualify as what? As a lease agreement under IFRS 16. Those are the three sets of category to be met to be qualified as a lease agreement. So let's go to the next slide, please. Christy, are you there? To the next slide. So what are the key changes made in IFRS 16? What are the key changes in which IFRS 16 brought? Number one is to recognize lease liability. Number one is to recognize lease liability, that is, recording of lease liability in the financial statements. Lessee recording the lease liability in the financial statements. Number two is to recognize right of use assets. That is, recording of right of use assets in the financial statements. And number three of this is introduction of what? Discount rates. So those are the key three changes to IFRS 16. Please note that these three changes affect the book of what? Of the lessee. These changes affect the book of what? The lessee. You that rented that asset, the tenants, affect what? The book of the lessee. That is the occupants. Let's go to the next slide, please. Christy, please, to the next slide. Yeah, thank you. So recognition, measurement, and presentation of lease liability and right of use assets in the financial statement. Now, this is where we need to relate and communicate. At this point, I would like us to get our calculator, calculating material close to us. Let's get our calculating materials close to us. Be it MX Excel, open the workbook. Please open the workbook. And be it calculator with pen and paper, let it be available by your side. And if you are good at calculating offhand too, it's allowed. Just be alert. So anyhow, we have to solve. Hope we are set. All right. Please to the next slide. Yeah. Thank you.
Toby, please,
okay.
1 second. Please,
Right.
thank you all for paying adequate attention. Please, I would like us to make use of chat bots for our questions in order to maximize our time. Thank you. Don't let us forget to send in our question. Thank you so much. Toby, you may continue.
All right. Thank you very much. Thank you. All right. When the lessee enter into lease contracts, as I've said, it recognizes what? Rights to use assets and what? Liability. Lease liability in what? In the financial statements, which are what? The new changes, right? As I've said. So how will you measure, recognize, and what? And present this lease liability and right of use asset in the financial statement? Number one, let's look at the definition. Let's look at its definition. Lease liability is what the lessee owns to the lessee for using what? the lease assets. That is what the lessee owes the lessor, which is the landlord, for using what? The assets, the lease assets. But under IFRS 16, the initial lease liability is the present value of all lease payments expected to be made by the lessee over the lease term, using what? A discounted rate. And that is where we derive that discounted rate from, which is one of the new changes to IFRS 16. That is bringing together all the lease payments you have made, you want to make for 5 years, for 10 years, back to its present value, choosing what? A discounted rate. So the discounted rate here can either be an incremental rate, that is rate in which you, the lessee, borrows from the bank, or a ruling rate. A ruling rate that is rate from CBN. So it depends on how you acquire what? Your discounted rates. Maybe you are using incremental rate. It's just for you to disclose it. This is what I'm using in the note to the financial statements, because they will ask, how do you get your discounted rates? So it's not before for you to what? To note it in the note to the account. Hope I'm communicating. Hope I'm communicating.
Yes, you are.
All right, thank you. So now,
Yes, you.
okay, thank you. Now let's assume ABC Limited, your company, enter into a lease agreement with S&I Leasing PLC to lease an office space for 500,000 per year for 3 years. Let me read it again. ABC Limited, your company, enter into what? A lease agreement with SI Leasing PLC, is a famous leasing PLC, leasing company, to lease what? An office space for 500,000 naira per year for 3 years. In a layman calculation, they will tell you 500,000 is times 3. They get 1.5 million, right? So at the end of the 3rd year, you'll be paying what? 1.5 million. That is a layman calculation. That is 500 times 3. That will be what? 1.5 million. However, under IFRS 16, the initial lease liability is the present value of all future payments using what? A discounted rate. So the sum of, and not just what? The sum of that 500,000 times 3, which will give us what? 1.5 million. So how can we get our present value of the future lease payments at the end of the 3rd year? So from this scenario now, let's introduce 5% discounted rates. Let's introduce 5% discounted rates, and let's apply it to 3 years rental agreement with 500,000. So what will be our present value? What will be our initial lease liability? Hope I'm communicating.
Yes, you are.
And so I want someone to tell me what we are going to, now we have agreed that is not 1.5 million, right? It's not 1.5 million. So what will be the results after we apply? No, Christy, no. Okay, thank you. So what will be the results after we apply the 5% discount rates? Please, I want us to work and give me the answer before we proceed. Please, are we working? Please let me see it in the chat box if we are working.
Yes, we're working.
Please, I need you to work. So let me assist us the more. Let me give you the discounted factor formula. You know, the regular 1 plus R into bracket raised to power minus N. N will now represent 1, 2, 3. I think I've tried. So what will be our what? Our initial lease liability? We have said it's not 1.5. So what will the answer be? The answer have to be closer to 1.5, but it's not 1.5. Because we are applying the present value what? To bring all the future to the present using what? A discounted rate. Let me assist us for those that are using MX Excel. Those that are using MX Excel, for you to get the raise to power, you have to press down your shift key and 6. That's where you get your raise to power. For those people using Excel, you have to press down your shift key and press 6 to get your raise to power.
Okay, can we just give the answer using Excel?
It's possible. I want you to work it out for us. Yes. You get the answer using Excel perfectly.
Yeah, it's 1,000. I mean, 1,361,624.01 is what I have.
That is it. Christy, please, to the next slide. So you can see the way it is. You can see the formula. So we are not holding on to 1.5 million, but 1,361,624.01. I think that is clear enough. Hope we can continue. So we are able to get the measurement for initial lease liability. So how are we going to present this in the statement of financial position? How are we going to present this in the statement of financial position? Christy, that leads on to the next slide. Let me see the next slide, please. Let's look at this. This is how it's going to be under liability as what? Non-term lease liability. It will be under liability as what? Long-term lease liability. Non-current liability as long-term lease liability. All right. So I think, hope I'm communicating.
Yes.
Hello?
Yes, you are.
Okay. All right. Thank you. So we can go ahead, right? All right. So let's look at the subsequent measurements of lease liability. Let's look at the subsequent measurements of lease liability. Subsequently, the lease liability is managed using what? An amortization schedule. The lease liability is managed using an amortization schedule. That is, as the lessee make payments, the lease liability reduces, right? So the amortization schedule will show the movement of payments over the years and the balance payable at a glance. Mostly amortization schedule can be achieved using MX Excel with formulas and functions. That is part of what we do at QuestKnow Services. We train on Excel from basics to advanced level, using pivot table and Power BI to design powerful dashboard for presentation. So we will give you the full detail about us after some time. Please stay tuned. So let's look look at how the subsequent measurements of lease liability will look like. Proceed to the next slide. Yes. Let's study this. No, please go back a little. The first one, not this. Let's look at the first one. Linking the results to the table. So you can see 1.61624.01 will be what? The starting point, the lease liability at start. Then we charge 5% interest rate, which gives us 68,081.45. Adding it together to what? To deduct the lease payments. Giving us what? 929,710.35 at the end of what? The first year. That's portion highlighted in yellow are the formulas. So if you go through it, you know how those things were calculated. So at the beginning of the second year, we brought forward this 929,716.35, charge the same percentage of interest, we deduct lease payment. So we get 476,195.83 at the end of what? The second year. Brought it what? To the beginning of the third year. We charge the interest 5%, deducted 500. So at the end of the third year, we'll be having nil. We could have finished what? Payments. We'll be having nil. We could have finished the payment. Yes, let me quickly chip in this. There's some payment that is made at the beginning of the year. There's some that is made at the end of the year. You know, as a house rent, mostly we pay in advance. We pay before we utilize the fund. So mostly that one is at the beginning of the year. Then we have what? At the end of the most leases are what? Paid at the end of the year. So it shows that when it is at the beginning of the year, let's go to the next slide so that as I'm explaining, you'll see what I'm saying. Let's go to the next slide. So when it is at the end of the year, you are making payment at the end of the year. You first charge the interest. You can see this interest comes in first, plus to the principal, then less the 500,000 to get what? The end of the year balances. But at the beginning of the year, you first deduct from what? From the principal. Before you what? You charge the interest. And that makes the interest rate reduce. So when we talk of lease liability, most especially is at the end of the year. And that is the reason why we use the first scenario in our case. So let's go ahead, please. So how will it be presented in the financial statements? Let's study this. At the end of first year, we are bringing in our figure that we capture, that the one in the amortization schedule, we are bringing it out, we are bringing it in here as the beginning balance of 2020, of the first year. And the second one will be what? 476,193.86. Why the end of the third year, we have nothing to pay. We could have finished payments. And that's the reason why, as an auditor, you need to request for what? This amortization schedule. That one will give you a clue of how they are paying. You have to correlate it with what they are paying. That is part of the audit process anyway. That's part of the audit process. So look at the expenses too. And the payments, all we go to what? Other comprehensive income. Statement of profit or loss and other comprehensive income. You can see the way it's stated, income expense on leases, lease payments. Hope this is gotten as well. All right, I think that is fine, right? Let's go on to the next slide. Right of use assets. Right of use assets. Right to use an asset as an occupant. The right you have to use that office space is what we call right of use assets. the right you have to use that leased car, and so on, is called what? Rights of use asset. And that's how the name was initiated. Rights to use what? That asset. Now, rights of use asset is calculated at also the present value of all payment expected to be made during the year, which you have done earlier. But in addition to what? Indirect costs. That is the cost you incur directly to what? To the lease term, such as the agency fee, the agreement fee, the legal fee, and so on. And deduct what? Deduct reimbursable. That is, there's some capital project you do in that leased space that the landlord has promised to refund to you. So it will be a deduction in your books. So as an individual entity, initial direct cost varies. All you need to do is to tailor it down to your entity lease arrangements to determine what initial direct cost is and your reimbursable. So in conclusion, the right of use asset is typically categorized as what? As a non-current asset, because it represents a long-term right to what? To lease assets. A long-term right to use what? To use that leased assets. So from our scenario, from the first scenario we pasted, Chrissy, let's go to the next slide. I think we have, there's some question that has been, I think the question is also here too, but we will have access to it later. From our first scenario, ABC Limited, your company, enter into an agreement with SI Leasing PLC to lease an office space for 500,000 per year for 3 years. Now, you incur 100,000 legal fee for negotiating the lease time, 50,000 commission paid to agents, and 40,000 for capital renovation of the apartment, which is what? Reimbursable. From what? From the lessor. So calculating right of use asset according to its definition. So who can quickly give us the answer? Who can quickly give us the answer, please? I have said, the way we saw it there, that the right of use asset is still the present value of the future payment being discounted, adjustments with what? The indirect cost and reimbursable. Now we have addition of reimbursable of 40,000, 100,000 for legal fee for negotiating the term of lease term. Then we have 50,000 commission pay. So what will be what? The ROU asset according to its definition. Let me give us some seconds to do that. Okay. Let me give us some minutes to do that. But pending that time we are using to resolve it, let me quickly chip in this. Christy, please, can you display this presentation? Or no, not here, not here. I mean, can you unshare this and present the presentation slide? Maybe you can, let me see. You are giving them the answer already.
Hello? Did you say I should
Hello,
stop sharing?
Yes, stop sharing. You want to share that presentation slide for QuestKnow service. So that they'll be working on this.
Okay.
Yes, let's unshare this, please.
I've minimized it.
Yes, okay. You can unshare so that we put up that. Do you have the presentation? I think I sent you.
I will bring it up now.
All right, thank you. That's the presentation for QuestKnow service.
So for the first year, yeah, for the first year, I'm having 586,190 as a right of use of the asset.
By its definition, right of use assets is the total present value brought into what? The total future value brought into its present value. Then what? We adjust for initial direct cost and what? Reimbursable. That is the initial definition, the definition of lease liability. I think we are not getting it. Right of use asset is the present value of all payment expected to be made during the year. Or after we have gotten all, we will now adjust for what? The indirect cost and what? The reimbursable. Okay. Sorry, minutes. Maybe let me see whether I can easily share from here. Let me try it first.
I'm sharing already.
Okay, that's fine. Thank you. Okay.
It's right there.
Okay, let me try it from here. Confirm if you can see my screen. Christy, can you see my screen?
Yes, your screen is showing here.
Please, can anyone see my screen aside Christy?
No.
No.
No, we can't see your screen. I can't see your screen.
You can't open it from your hand.
A moment, then it's coming to my laptop. A moment.
Okay, all right.
Can't see your screen.
Chima,
I'm seeing it, sure.
Chima, please, can you see my screen from there? I want something to be shared on this platform before we continue, please.
I can't see your screen. Myself,
So
yeah.
Chima can't see my screen too. So what is wrong? What's something I've pressed?
I can see your screen. I can see your screen.
You can see it. Is that Chima?
Yes.
So can anyone else see my screen again? Aside Chima.
No, I can't see
No, I
your
can't
screen.
see your screen.
No, I can't see your screen. I can't see your screen, no.
So, Chima, please, you will need to share this for me.
No, I can't.
Okay. Chima, please, you need to share this for me. We need to do this before we continue. Then later. Okay. Let me stop sharing since you are not seeing it. Okay, I'll stop sharing. Chima, you can share your screen, please. Have you seen it?
Can you just reshare it?
Okay. So no one can see my screen. So, Chima, please, can you share this? Maybe, please, let me re-log in or something.
I think you can still share because I'm not with your slide. So you can share. And I am seeing it. I am seeing it from two devices.
But people said they are not seeing it. Say they are not seeing it. Sorry, can anyone else confirm that he or she is not seeing it? Hello? Hello, am I audible? Sorry, please. Hello?
Toby, we can hear you. Hold on. I'm trying to bring it in. Hold on.
Okay. All right, let's continue.
Let people continue.
Okay. Let's continue as Christy comes up. So who is with the answer now? Let me stop sharing. Let's go back to our right of use assets. I said right of use asset is typically categorized as what? Non-current assets. And is the present value of all payment expected to be made during the lease term. From you have a lease agreement of 5 years. All the 5 years has to be brought to what? To its present value using what? A discounted rate. And that is what we call initial lease liability. Now we want to use for right of use. Right of use is not telling us that all that payments that you have discounted, now adjust it to what? To fit the indirect cost are reimbursable or incentive. So what will be our answer as the question we have displayed so far? That we have 100,000 naira for legal fees for negotiating the lease term, 550,000 commission paid to agents, and 40,000 for capital renovation of apartment, which is what? Reimbursable. So who is with the answer? Let me assist us small. What we need to do is to bring down what? The lease liability. We have the initial lease liability, right? It shows we are not working. I want to hear the answer from your hand. You know we have the lease liability already. All we need is just to adjust for the what? For the difference. I need the answer from your hand. We have more complex work to do. Please, let's work so that we can easily finish in time. Okay. Christy, please, maybe you put up the slide so that they can see the answer from there. I know they've already done it. They have the answers. It's just that they don't want to disclose it. Listen. I know we already have the answers. It's just that we don't want to disclose it. Please display the results so that we can move.
A moment, please.
All right, then. All right. Okay.
I have the answer here.
All right. Thank you. Please, let's look at this. Let's look at this. We said the ROU is what? Let's study that. The ROU is the present value of what? All payment expected to be made during the lease term, right? Add any indirect costs, that is agency agreement, and what? Deduct reimbursables. You can see we brought down our 1.361,624.0 down here as the initial measurement of lease liability. Then we adjust for what? For the expenses.
Sorry, can we have full screen?
Sorry?
Can we have full screen? Just it's tiny on the phone.
Okay, it's tiny.
So
please help us put it in a slide mode. Amen.
Are we okay? Are we good?
Yes, I think we have.
Yes, thank you.
So let me explain it again. We can see the initial lease liability we had, which is 1.63, 624.0.0, brought down. Then we adjust for the cash inflows and outflow. The legal fee is the money you have already incurred. Is your cash outflow already. The commission paid to agents, you have already incurred it. Is your cash outflow. The reimbursable, you deduct it immediately. You are deducting it immediately. Because when the landlord says, okay, sir, please, we repair our door, the major door, so we have to change the door. What you have is 200,000. Landlord will not refund the money to you. He will tell you, remove it from the next house rent. No landlord will say, okay, take cash. Because you have done, take cash. No, he will tell you, remove it from the next rent you are paying. Exactly what happened here. We are removing it immediately from what? From the lease liability. To get what? The right of use assets. So, let's continue. How will this be presented? How will this be presented in the financial statement? That leads us to the next slide. You see, please, the next slide. Please, the next slide, please. Okay, yeah, fine, thank you. So let's study this. We can see. Yes, it's fine, it's fine.
Toby, please, are you there? Toby? Please, can anyone hear me?
Yeah, we can hear you. Fine.
Yes, we can hear you.
Yes, we can.
Yes, we can hear you.
Since we have lost Toby, please kindly hold on, I'm coming.
So how are we going to present this? Okay, this is how we are going to present this in the financial statement. So what are the differences? No, we have to balance the accounts. The account needs to be balanced. Please, to the next slide, please. To the next slide. Okay. Apologies for the network issue, please. We are trying to adjust this. And I know next time everything will be fine. Let's look at how the cash goes in and out. Let's see how the cash goes in and out. You can see the leg. The cash outflow is the legal fee. The cash inflow is what? The deductible, which is the capital renovation of the lease agreement. That balances the account. So all these ones will go into cash inflow and cash outflow because it's fund that we have already what? We have already exhausted. We have already used. So let's go to the next slide. See what's how. Please, let's go to the next slide. Let's see how we are going to measure it subsequently. What is the subsequent measurement of ROU? The first one we did is the initial measurement. We have done the initial measurements for lease liability, and we have done the subsequent measurements for lease liability that we said we are going to make use of amortization schedule. That is what the subsequent recognition for lease liability. Now, we have done the initial recognition for ROU, which is the one we did that we said present value. They adjust for indirect costs and reimbursable. Now, we are looking at the subsequent measurement of right of use. Subsequently, the right of use is measured at cost less accumulated depreciation in accordance to what? IAS 16. Just the way you treat your what? Your PPE. Now, the right of use asset is what? Is now your PPE. You are going to treat it the way you treat all the assets by depreciating them throughout their lifespan. That lady you met in a team that have 10 children for you, and you are still not capitalizing it as an asset. Now, IFRS 16 mandated it for you that you have to what? You have to capitalize it. Usage, not what? The legal food. I know one of my friends, Femi, they said that women are liability. Why should we say women? It's not a liability. He has children for you. All our life is with you. And that is how we have some companies. They've leased a building for 10, 20 years. It's not that they don't have money to live, but they can't leave the place because they've already invested, they've already gotten their customers around that area, around that location. They can't leave. They are renting with their parents on daily basis. They've already established themselves there. So for them to leave will be very difficult. So this liability will be the initial present value to present, giving it as a present value, and the right of use assets will be adjustment to right of use. So let's go ahead, please. Let's go ahead. So how is it going to be presented in the financial statements? Let's look at it. So how is it going to be presented in the financial statement? Let's study this. That is, we are bringing in the 1.476 down here for the first year. The depreciation will follow by deducting it. Then we carry forward 8.1836 here. Then the 4 points. Let's study it. So this is how it's going to be presented in the financial statements. So let's quickly look at the lessor's side before we go to lease modification and sales and leaseback transaction. Let's look at the lessor side. To the next slide, please. Recognition measurements in the books of the lessor. Lessor accounting has a dual lessor model approach, which includes two classes of leases, like the operating leases and the finance lease. An operating lease is when the lessor, that is, the owner of the identifiable assets, keeps most of this risk and reward associated with what? Owning the assets. So, the lease assets are shown under what? PPE, because it's the owner. So, the assets are shown under PPE, under lessor's statement of financial position. And they are depreciated according to what? ISTC, normal depreciation, and also test for impairment too, just like other long-term assets. While a finance lease is when the lessee, that is the renter of the asset, takes most of the risks and reward linked to owning the assets. Take most of the risk and reward links to owning of the assets. So for lessee, to qualify as a finance lease, lessor record a lease receivable equals to what? All expected lease payments over the lease. I assume everybody knows about the lessor's treatment in his book. He's the owner of the assets. And when you own an asset, it's an asset to you, so you capitalize it. And when you are expecting an inflow, when you are expecting an inflow from your tenant, it's a receivable. So all those ones are what is there when we want to record the lessor's parts. So IFRS 16 specializes mostly on lease, on lessee. Okay, let's go to the next slide. Christy, thank you. All right, this is where I want us to pay our utmost attention so that we not have to repeat, or so that there will not be a lot of questions. All right. So Christy, please, do you want to bring up the presentation now?
Yes, but I will need to stop sharing.
Okay, yes, please stop sharing, please. Let's look at the presentation, please.
Yeah.
All right, thank you. Oh, okay.
So I suggest that you continue. Let's continue with the presentation while I find another means of getting it.
All right,
Please.
thank you. Okay,
Put
so
that,
let's pay
please.
attention to this. Please put up the slide, please. Put up the slides. Let's see the
The slide is here. The slide is here.
all right.
Full screen, I beg. All the
Please let's back to the first slide, the lease modification and sales and leaseback. Not the question. Yeah, thank you. Yeah, this is where I want it to be. All right, thank you. So here, lease modification means making changes to the terms of an existing lease agreement between the lessor and the lessee, which is the renter. These changes is of various types, but we are going to look at 3 of the changes today: the adjusting, reassessing, and the new lease. Under adjusting lease, that is making changes to what? To the existing arrangement, such as lease payments or rates, that is the discounted rates, without adding any asset or extending any scope. Let me repeat that. When there is a change in amounts or rates, it's called an adjusting lease, because you are just adjusting what has already been been agreed. That makes it what? An adjusting lease. So any question you say there's a change in lease arrangements, payments, and all the rate changes, it means is a what? Is an adjusting lease. All right. So let's go to the next one. The next one is creating a new lease, creating a new separate lease. So this occurs when the lease modification adds one or more original assets. Now, adding what? Additional assets. Or the lease payment also increases by some amounts. Also, with increase what? In scope. Because if the scopes increases, like you want to rent a flat, you pay, you have a lease pay. Later, you added 2 flats. Then your lease agreement increases. So as the payment, the house rent increases, so that the flats self increases. So that is what we call the scope. Then this results in a what? In a new lease, creating what? Accounting. You create an account separately for it. I've defined the adjusting lease as the changing in amount or rates, while the new lease is changing in scope, the asset himself, or increase in payments due to the asset increase. Hope that is gotten as well. Hello, hope I'm audible. No.
Hello,
Yes,
sorry,
you
can
are.
you please explain the adjusting lease and new lease again? The differential,
Okay.
the differential,
All right.
please.
All right, thank you. When we talk of new lease means you are entering into another agreement. That is, now the amount totally change, the rate totally change. That makes it what? A new lease. But when we talk of adjusting, before you can adjust anything, you could have an existing items. When we say adjusting, that is, you are adjusting what you have done. Just like the prospective in IFRS 8, you have already have the account. You are not going there to adjust. That is what we called adjusting lease. But when we saw a new lease, they will tell you in that question that, yes, this is a new additional lease we are adding. This is a new one. So they will tell you the scope have changed because if you added another rent, so you are making it as a new one. So it will be a kind of visible thing in that question. So new lease and adjusting lease. Hope I'm clear. Hope it's clear, sir.
Yeah, clear. Thank you.
All right, thank you. So let's go to the third one. Let's go to the third one, which is lease reassessment. Please, I want us to listen carefully here. Lease reassessment. It means recalculation. You are recalculating lease term or payment due to what? Changes in decision of the lessee. Let's assume now you are in a rented apartment and you have looked at it. You still complete your rent. You still complete your house at Ikorodu. You've given it plus or minus 3 years. So you have already told the landlord that I'm using 3 years here because I'll soon complete my house in Ikorodu. Now, let's now assume the second year. You now look at it that, materials has increased. Exchange rate has making everything increasing. So you can't continue again. Do you get? So you now inform the landlord that, sorry, I said I'm going to pack out here at the end of the third year. You are making this decision at the second year. You have already overseas that, in fact, you're staying there, you still extend it to another 2 years. So at the end of the second year, you now went to the landlord, please, I will not say to that, I want to extend to another 5 years. That is from year 3 to 5 now. You are added 2. Hope I'm communicating. Hello?
Yes, please.
All right, thank you. So let me go by definition. Lease reassessment means recalculating lease term or payment due to changes in decision or condition of the lessee. So these changes include exercise or not to exercise an option to extend or to terminate lease. As I said, the guy exercised what? Extension option. Because at the end of year 2, he has looked at it. I can't make up again. I can't make up again. Let me tell this landlord before he changes his mind that I want to add additional years. That is what we call option to extend. We are still going to go to a critical example here. So what is the termination then? Let's assume now that after the landlord that's already agreed, the lessor, let's use the lessor, has already agreed, okay, I'll give you 5 years. Because of what you say, at least I can't send you out. Yes, so let me give you that additional 2 years so that you'll be able to complete your building. So after the 4th year now, you now realize that you have already completed the building. So you don't need 5th year again. So you terminate the lease liability for the 5th year. And that is where termination comes in. Hope I'm communicating. Now, where we are going now. Let's use ABC as an example. ABC agreed with SI PLC to stay in that lease apartment for 3 years. And after the second year, due to materials that goes up and high cost, no, they cannot continue the lease. So they quickly extend to what? Additional 2 years, making what? The 5 years. So from this scenario now, ABC Limited has exercised an option to what? To extend. ABC has what? Exercised the option to what? To extend. Now, let's stop here and go back to the definition according to IFRS 16. IFRS 16 says, requires that lease liability and right of use assets in this content should be what? Recalculated to reflect the current changes. The lease liability and the right of use asset should be recalculated to reflect what? The current changes. So how are we going to reflect these current changes? That is, we are changing, we are extending. Let's first take it from extension before we go to termination. We are extending from end of year second. Now we are extending starting from the third year to add fourth and fifth, right? So how are we going to reflect these current changes? It will reflect the current changes by bringing back the year of change to what? To current year. The standard said we should reflect in the current changes. When we look at it, that is, you are looking at the recent fair value, the recent updates. You are bringing back what? The old one to what? To be the recent one. So the year of change will now be what? The first year. Which is what? The current year now. That is, instead of using the discounted factor for 3 years, you know, our regular formula, 1 plus head into bracket on that raised to power minus, supposed to be 3, right? But now it will be 1 because we are bringing it back to what? The current changes. What you have already fair value since how many years? 3 years ago cannot be the same this year. That is what this reassessment is saying. It cannot be the same this year. So we are going to what? We are going to scatter it and remove it back. So we are bringing back what? The third year to be what? The first year. Now the fourth year will be the second year. While the fifth year will be the third year. Hope I'm communicating. Hope I'm communicating. Is that? Please, I need a response from your hand.
Yes, yes.
All right. Thank you. Now, let's look at. All right. Hope I'm communicating, please.
Yeah, if you can go over it, it's quite complex.
Yes, please.
Yes?
Yes, you are communicating.
All right. Okay. Thank you. Now, let's quickly look at that termination of it. Now, we said after the fourth year. After the fourth year, the one said he's not interested in the fifth year. At least I've completed my house in Ikorodu. There's no need for me staying here for another year. So he met with the landlord that, please, this lease agreement, I want it terminated. That is option to what? To terminate. That is the lease has that option to what? To terminate. So now, let's go back to the standard. According to IFRS 16, it says the lease liability and the right of use asset must be what? Recalculated to reflect what? The current changes. So starting from that fourth year now, the fifth year will be what? Will be 1. Will be 1 instead of what? Using raised to power -5. We use raised to power -1 because we are reflecting it into the current changes. Hope I'm communicating. So we have 2 changes there. Number 1 change is that he said the landlord should give him 2 years so that he'll be able to complete his house at Ikorodu. But after the 4th year, that was the first. The second one is that after the 4th year, he begged for termination. That is, it changes how many times? It changes twice. It changes twice. So, according to that standard on reassessment, you are going to treat it as if it's reflecting what? The accurate reflection of what? The current changes. So where you need to use 3 is 1 you will use. Where you need to use 5 is 1 you use because that is the year of what? The year of changes. Hope it's clear.
Yeah, clear.
All right. So let's look at sales and leaseback definition before we now go to questions. Christy, please, have you stopped sharing?
Yeah, my system just went off. It's coming up. Can
Okay,
continue. Let me use my phone.
What of the presentation were you able to do?
It's still coming up. In fact, that's what affected the system, but I'm coming.
Okay. So please put up the slide so that we can.
Sorry, I'm trying to navigate with my phone.
Okay.
I'm coming,
all right.
please.
All right.
Sorry.
Please, we apologize for this distraction today, and it's due to network issue. We appreciate your stay, and we don't take it for granted. Apologies for this, please. Hello, Christy, please help us put up the slide. Put up the slide.
I'm so sorry. My it's not coming up on my phone, and the system just finished
I don't know.
booting.
Can anybody help us share the screen? Chima, please, can you give access to someone else to share the screen for us?
Toby, you can just continue speaking to your slide. Continue speaking to your slide.
Okay. Sorry. Oh, hello.
We can see it now. We can see it now.
You can see my slide now.
We can see your slide.
Oh,
we can see your slide.
Okay, that's
go
fine.
ahead.
That's fine. That's fine. That's
Just
fine.
go ahead. And you can try the presentation as well now.
Okay,
So
please let
we'll
me try the
see it.
presentation first. Let me stop sharing. Okay, thank you.
Thank God.
Hope you can still see my slide.
Yes. Yes.
Okay, that's fine. Yes, hope you can see my slide.
Yes.
Yes, we
that's
can see your
fine.
slide.
Yes, you can.
Okay, so let me quickly use this medium to share with you a bit about QuestKnow service and how we can help enhance your professional skills and knowledge. We specialize in providing top-notch trainings on IFRS and other professional topics, offering both courses online and virtual to cater for your conveniences. So we are proud to conduct this training at ICANN level, both in the districts and in the zonal level. So let me walk you through what QuestKnow training does. First, we have our data analysis and data cleansing training. This comprehensive program is tailored to enhance your analytical skills, equipping you with the tool and techniques to clean and analyze your data effectively. So we provide dashboard reporting training using both Microsoft Excel and Power BI to create an impactful and valuable skills. So our training will guide you through the process, building dynamic dashboard that can drive your business forward. So, you know, in today's data-driven world, mastering this skill is essential. And our training is to ensure a well-prepared personnel to handle what? To handle the training. We also train on Excel from basics to advanced level, and that is tailored to your specific need. You know, Excel is very wide. Excel is very, very wide. So it will be tailored to your specific needs. And our goal is to make you an Excel pro. So why not take a step forward to enhance your skills and contact us today? For more information, our phone number will be displayed very soon, and our email address for more inquiry and booking. So thank you all.
Okay, thank you. Can we ask a question?
Okay, you can go ahead.
Well, thank you for your offerings. I want to ask your offer on data analysis.
Yes.
Number one thing, I would like to know the fee and the duration,
okay,
and the scope, because in data analysis is very, very interesting.
Yes.
Apart from visualization,
yes,
one of the key aspects is interpretation.
yes, you have
And
our contact on the
interpretation-
screen now. You can contact us. 070-7522-7448. Let me display it again.
Go ahead.
Let me display it again. 070-7522-7448. Anything you need to know about data analysis and both Excel data cleansing, using of pivot table to prepare a powerful dashboard, and also using of Power BI to prepare a powerful dashboards. That's what we do at QuestKnow. So contact us today for booking. So thank you all. So let's go back to our slide. I think I can share now. Let's go back to it. Christy, thank you very much.
Yes, you can go ahead.
Yes, I can share. Thank you very much. Thank
yes,
you.
please.
Hope you can see my slide now. We have explained 3 modifications to lease agreements. Number 1 is the adjusting lease. Number 2, creating a new lease. Number 3 is reassessment. The accepted means recalculation. You are recalculating it. Now, according to IFRS 16, you have to bring in what? Factoring in what? The recent changes. And how are you going to factor the recent changes? By fair valuing it to the recent economy situation. Making you to be what? To bring it back to what? To new changes. I think that one is good. So let's solve some questions before we go ahead with the other ones. So what you can see my screen. Limited enter a 3 years lease for office space with annual payment of 500,000. After 2 years, they decided to extend the lease by 2 more years due to what? Changes in business circumstances, making it what? Total term of 5 years. However, at the end of the fourth year, sorry.
We can't hear you clearly.
Background noise, please. Please let us control the background noise. Okay, thank you. Let me read from the beginning. ABC Limited enter a 3 years lease for office space with annual payment of 500,000. After 2 years, they decided to extend the lease by what? By 2 years more, due to changes in what business circumstances, making the total of 5 years. However, at the end of the fourth year, another change leads to them to decide to what? To exercise the extension option. Returning the remaining term back to what? 1 year. So which of the lease modification is this? Calculate the lease liability and right of use asset, assuming 5% discounted rate. I know it's a long calculation. It's a long calculation, and I don't know if you want to try, because we have not been able to answer since. And you can help us at least interpret, not to calculate now. Who can help us interpret this? Who can help us interpret this? Okay, let me just read the list. The initial lease agreement is what? Let's look at it. This term is 3 years, right? Annual lease payment is 500. So after 2 years, decision to what? To extend lease by what? 2 years. That is the new total lease term is now what? Original 3 plus what? 2 extension. Give us what? The 3 years. So at the end of 4th year, ABC Limited decided to what? To exercise the extension option. For what? For the 5th year. Remaining this term returns is what? 1 year. That is 3 years plus 1 year extension effectively used. Therefore, they ended up using 4 years out of what? 5 years. Hope this question is clear. So, extension option for the 5th year is what? Is terminated at the end of the 4th year. So let's look at the solution here. Hope you can all see my screen. Let's look at the solution. Christy, please, can you help me mute everybody so that we just try to curtail the background noise? Is there anything we can do to stop this background noise, please? All right, thank you. So from the explanation on the screen, Let's start from here. In the book of the lessee, the present value of an annuity, what do we call annuity? That is, we are totaling the first year, the second year, and the third year together using a single formula. Instead of what? Instead of splitting it into 3, we are bringing all the 3 years together using this formula. That is when we want to get what? The present value at a glance is an optional. I just put it here so that you know that there's another formula we can use to get the 3 years at once, instead of splitting it into different years, 1, 2, 3. So this is called the present value of an annuity. And this is the formula. And this is how to input the figure. That is the payment times 1 minus into bracket 1 plus r raised to power, close bracket, raised to power minus n divided by the rates. So let's go to the next one, which we are going to use. That is the table, because I prefer the table so that we can see how the inflows, so that we can see the inflows at a glance. You can see 500,000, we put it into discount rate. We get, so at the end of the year, all what we have, totally the lease liability for the first agreement. That is the first agreement we made, that we want for what? For 3 years. You told your landlord is for 3 years, I want it first. So the agreement for 3 years is what? 1.361,624.01. That is the first agreement for 6 years. So when it's now, after the second year, the second year, that is at the end of the what? The year 2. The remaining balance we have is what? Is just for what? Year 3. That is only 1 year remaining out of 3, because we have used 2 already. So with that aspect, now we now go to the landlord again and tell them that we need what? An extension. We need an extension to add what? To add the 2 years, which is 4th year and 5th year. That is, the changes started from what? The 3rd year. So how are we going to treat the 3rd year lease payments? As I said, according to IFRS 16, we are going to bring it to reflect the what? To reflect what? The current changes. So we bring it back to what? The current year, which is 1. And that is what we do here. Hope you can see my cursor. You can see. Hope you can see it. We are bringing it back to what? To be 1. Hope I'm with someone. Hope I'm communicating.
Yes, you are.
Yes,
Okay,
ma'am.
thank you. Okay, that's fine. That's fine. So we are bringing it here to be 1, as the standard says. Now, after the 3rd year, we have that one first. After the 3rd year, we now have another extension, another termination. That is after the 2nd year. We have another termination that the 5th year, we are not going to exercise any right again. We are not going to lease again. We what? We extend it. So let's first calculate for the first one. Now, we have the total already. The total is 1.361,624.01. And we have already fair valued that one, which is we are starting from 1. Look at the slide. That is, we are starting from 1 now. Have you seen it? We are starting from 1, 2, and 3. This 1, 2, 3 represents the 3, 4, 5. If you look at the next one, decide to extend lease by 2 years. That is year 4 and 5. So the first one we are having here is the 3rd year. Now, coming back to what? The 1st year. Hope I'm communicating. Let me hear from you. Hello? Oh, I should repeat myself. Yeah? Is it clear?
Yeah, very clear.
Oh, that's fine. So now we have, instead of having 3, 4, 5. Now we have 1, 2, 3 because we are reflecting it to be what? The current value. That gives us, you can see from this, total lease liability after extension will be odd 3, 4, and 5 years, which gives us 1.361, 624.01. So that is 1. And at the end of the 4th year, as the question says, so decision to what? To extend to the 5th year was what? Was terminated. So we have one effectively. Do you get? We have 1, which is 5 years. 5 years now will be brought back to what? The current what? The current what will not be what? 1 instead of what? 5. And that is what we do here. Look at it. You can see. So eventually, bringing down 1.361, 624.01 less the 5th year, which is 476, 190.48. We give us what? The recalculated lease liability. That solves the question. What we are trying to bring up here is to reflect the changes according to IFRS 16. Any changes made by the lessor will actually be recalculated to what? To the recent year. So let's assume now in another year, he said, no, I don't want this. You will start from the beginning. You will not start from that 5 or 5th or 6th because it has to reflect the current words. What you have fair value since 3 years ago cannot be the same this year. That is what assessment is saying. What you have fair value since then cannot be the same now. So you have to let it reflect what? The current value. And that is what IFRS is trying to portray. Transparency, bringing everything out. Flexibility, let it be transparent. The fair value you are using, let it be the current one. Everything you are doing, let it be current. Hope I'm communicating.
Yes.
All right.
Yes.
Thank you. Okay, let's go to the next question. ABC Limited, your company, entered into an agreement with SI Leasing PLC to lease an office space for 500 per year for 3 years. And after the 2nd year, the lessor increased the lease payments to 600,000 per year, effectively from the 3rd year, due to increase of fuel and other essential items. So what is the RO? The RO asset carrying amount at the end of the 2nd year is what? Is 490,541.34. That is, we have 3 years. No, we have already divided it initially. We have already exhausted what? The 2 years. Remaining what? Carrying amount will be what? Only 1 year that remains after the end of the 2nd year, right? And that is what we put here. Now, what type of lease modification is this? And calculate the lease liability and right-of-use asset, assuming discount rate of what? 5%. Let me point out something here. The lessor increased the amount. That is number 1, that would be prompting. Increase the amount from 500 to what? To 600. Effective from what? The 3rd year. Due to increase of exchange rates. Some other will tell you because of exchange rate, I'm increasing rate. You'll not be looking at, did you import anything from, do you import any material from abroad that is now saying exchange rates? You know, people will just use 1 or 2 things. I know we could have experienced that recently. The rate will just increase. They'll tell you it's because of the situation of things, and that is where they are eating. You don't have any choice than to renegotiate. Yes. So the payment changes for 500 to 600. I think it's still reasonable. It's still reasonable because we need to factor in the fact that that's his retirement. He doesn't have anywhere he's eating. So we need to consider it too. So fuel and other essential things. So how are we going to treat this? Can someone tell me what kind of lease is this first? At least let me hear from your hand. What kind of lease modification is this? Hello?
New lease.
Lease modification. Increasing from what? From 500 to what? To 600. Is an adjusting list. Thank you, sir. Because we are just adjusting the amounts. It's just an increment. It doesn't tamper with the old thing. They said after the second year, the lessor increased the rate, not a new lease. It's an increment. So anyway, you see increment of payment that doesn't apply to extension or adding of new assets. He said it doesn't, it's because of fuel and other things that goes up. That's the reason why it's increasing. It's not because the lessee add another flat. No. So it's an increment. So how are we going to treat this? I don't want us to make much of our time. Let's just go to the next slide. So you can see the initial lease payment 500, modification lease payment 600 in 3 years, then the rate 5%. So look at how it will look like. Let's study this. Let's study this. You can see the first 3 years, we have our total, the first 3 years. So the adjusted lease there is what? Is the 3rd year. You can see the old 3rd year and the new 3rd year. The discounted rate is still the same. Nothing changes. So you can see that it's different from what? The reassessment list that we did. That we, according to the standard, we are bringing it to the current value. That one is different. This one is just, we are just adjusting what? The amounts. So, after we have the new, Abby. So we have to look for the changes because we have the old lease payment in the ROU before. So we just have to adjust for what? For the difference. The difference is 86,893.38. Then, as I've said, how are we going to calculate for the ROU after 3 years? We only have the last depreciation inside the last amount, depreciation inside the ROU, which is the 490. Let me get the figure. Let's quickly go back so that I'll show you that figure. From that's where we got it. You can see for the 3rd year, we only have 541.34. That is what we are having as the carrying amount as at that year, 3rd year. So let's go back. And our question carries it. So now we have 490, sorry, there's sorry, please. So carrying amounts of ORU after 2 years will be 490, 541.34. We will now what? We adjust for the 86,000. We just add it to it. We just add it to it because it's the difference. Difference is what? In the amounts. That is 100,000 naira. When we net present values, we get 86. So we add it back to the ROU to give us what? The total adjusted ROU assets. Which will be what? The depreciation for only 1 year. Because that's the last year. Hope this is clear too. Hope it's clear.
No, I want to ask a question. Why is the figure for the adjusting in bracket and in negative?
Sorry, I didn't hear that. Please repeat the question.
Your new adjusted lease liability, right? Using the 3rd year what is the discount factor.
Okay.
It is in bracket of 518, right? So I said, why is it in bracket?
Brackets. Let me go back. No, we just want to remove it. I did it like so that we know the difference. I'm trying to give us the difference. That's why we are deducting this from this to get the difference. It's not, we are not looking at that bracket. I just want to let us know that we are deducting it.
Okay.
Sorry, are we fine?
Fine.
Okay. So we are deducting from the new from the old to get the difference. And we add it back to what? The ROU. So let's go ahead. I think it's clear. So let's take this again. ABC Limited, your company enter into a lease agreement with S&I Leasing PLC to lease an office space for 500,000 per year for 3 years. After the 3rd year, ABC Limited decided to create a new lease, agreeing with what? The additional year for 4th year. Okay. And add a new asset to the lease. Increase the annual lease to what? To 700,000. So obviously this is what? A new lease. Because we are having creating another new lease agreement which entail addition of what? 4 to 4 years, and also increasing to what? 700,000 due to what? The increment in what? Due to what? The additional new assets. So let's see how it looks like. Initial lease time, annual lease 500, 3 years, discounted rate. Then the new lease will give us the annual lease payment, the extension, and what? The discounted rate. Let's see how it looks like. Please, let's study this. The first one is what? The old agreement. Why the separate new lease is what? Is the second one. You can see they are separate. This one extended from 1 to 4. But the first one is 1 to 3. But because they are creating another one that's extended to 4, with what? 700,000. It's extended to 4, the other one 3. So the ROU will be the same because there is no adjustment, no indirect cost mentioned, and no reimbursable mentioned. I think that is gotten to. The slide will be available for us. So let's look at sales and leaseback. I think that's the last one. Sales and leaseback. So why do companies engage in sales and leaseback transaction? Number one is to get immediate cash, which can be what? Useful for funding other projects. They don't want to tie assets down. It's better for you to sell it, have the cash, use it to invest. And number two, for them leasing out, for them selling and leasing it back, they still have the right to enjoy the same assets. They still have the right to enjoy the same assets. They've sold it fine. They've gotten the car. They still lease it back so that they will still have access to what? So that lease item. So anytime you hear sales, I know one thing that comes to mind is it a gain or a loss? That is the first thing. When you hear sale, anything sales, is it a gain or a loss? So how do we calculate gain or loss on sales? Is the sales proceeds less what? Less the carrying amount. The sales proceeds less the carrying amount. Why? Please note that the transfer of this asset must be in line with what? IFRS 15. There must be a lessor and lessee agreeing. So you have to follow the 5-step model to ensure that the sales qualifies for what? For lease. And as you have said, after you have leased it back, to do the needful by recognizing right of use assets and lease liability. So let's quickly look at the question here. ABC Limited sell an asset to ISI Limited for 2 million and simultaneously lease it back for 700,000 per year for 3 years. The current amount of the sold asset is 1.5. Calculate the gain or loss on sales of assets. The lease liability right of use asset, assuming discount of 5%. Let's quickly look at the solution because of time. We have sold the assets. Now we lease it back. We will recognize as the lessee. We are the lessee now. We will recognize what? The sales liability and right of use. So that one settled the first slide. The 700,000 at 5% discounted rate. Then we have the ROU because there is no adjustment. Now let's look at this. What we sold. We have to gain. We have to look at whether we gain or we did not gain, or we made a loss on the assets. That makes us what? The sales proceed less the carrying amount. We give up 500,000. That is, there is a gain on the assets. So the entries, we debit the cash. because the money came in. Asset is always debited. Then the asset, you remove the carrying amount by crediting it from the account. And you credit what? Your gain on sales of assets. I think this is gotten as well. And it's when we have the slide, we'll be able to go through them. So let's quickly run through the other parts so that we can conclude. Audit of lease liabilities and right of use assets. How do we audit right of use assets and lease liabilities? It's very important for us as an accountant to know how to audit, most especially for auditors among us. How do we audit this right of use asset and lease liability? Number one, so after you have agreed the balances from the prior year to the GL to the TB, you request for the lease agreement document. That will be the first thing you request for, the lease agreement document. This is to understand the time and condition of the lease. It's from there you'll be able to know, it's 5% the charge, or it's for 20 years, or it's for 15 years. That will give you the clue of the terms. Number two, request for amortization schedule. That is what? To analyze the subsequent measurement of initial liability. This is to confirm the amount and timing of the lease payment as agreed in the what? In the agreement book. They said, okay, they brought it down. It's what is in the agreement you brought down to the schedule. Does it align? Does it agree? You request for amortization schedule. Then number three is to request for what? For the discounted rate documentation. I told you earlier, discounted rate is gotten in several ways. Maybe the one incremental cost or incremental rate or the ruling rate, which is the CBN rate. You get the documentation. This is to review the basics for the what? For the discount rate, using what? Using the present value used. So you have to get what? That document to show, okay, this is how you calculate it, this is how you get it. The other one is to what? To calculate the use of, to determine the initial and subsequent costs and all others. All these slides will be available for us to go through. It's listed there so that we can go. But lastly, ensure the company lease accounting policy comply with IFRS 16. That is very important as an auditor. Ensure that everything they do comply with what? With the standard. So your audit will be based on what? On the standard. So let's quickly run through the disclosure, the key disclosure before we go, please. I'm sorry for taking your time. It's just that the way the thing is structured, we are sorry for that. We look at when you disclose the nature of the leasing activities. What is the nature of that leasing activities? This is to ensure the types of lease you enter into. Is it motor vehicle? Is it equipment? Is it vehicle? So you have to know, you have to disclose lease liability, disclose the total carrying amount of the lease liability, recognize what? In the statement of financial position, you disclose it. What is the carrying amount there? The right of use asset, disclose the total carrying amount of the right of use asset, recognize. Breaking down into different parts. Let them be separate. We have the properties, we have the lease, cars, and so on. Then the discount, as I said too, the discounted rate, what the discount rate you use, let it be disclosed. Then the changes in right of use, that is, the changes made modification. The modification, you explain the changes in the lease liability right during the reporting year. Maybe it's an addition, it's a new lease, it's a reassessment, and it's other changes. You have to make it known in the financial statement. Fine. That leads us to the next slide. When we look at big companies, they have a lot of, and mostly companies that deals with leases, construction company, airlines, and so on. They need software to do all this. So there are some specialized accounting software known as lease accounting software or lease management software, other than Oracle, Lease, finance management, and all the lights. So all these ones are available for large organization. So all those ones are available for large organization. So let's quickly look at the takeaway for today. IFRS applies to all leases with limited exemption for short-term lease and lease of low-value assets. Number two, leases recognize lessee recognize lease liability and right of use asset on the balance sheet for the most leases. Basically, changing lease accounting preparation by bringing lease into what? Into the balance sheet. So, in the era of IFRS 17, we added distinction between finance and operating leases. But now, with IFRS 16, that line is unclear. So, to the lessee, get ready to bring those lease liability and right-of-use assets front and center on your statement of financial position. So thank you for listening. Thank you for taking your time. I really appreciate your endurance towards the training. And before I stop the training sections, there is we have another flyer for next section, which is IFRS 9. IFRS 9 will be coming up September 22nd. IFRS 9 will be coming up September 22nd, but with a token. There, I promise, and you will get everything concerning IFRS 9. You know, it's a kind of a little bit complex standard, but breaking it down, it should be much easier. So let's look at the flyer. It will also be sent to our box. It will also be sent to our box. So it will also be sent to our box too. Please, Christy, please, are you there? Christy? Please, can
Yes,
you
I'm here.
Please, can you
I'm
put up
here.
the flyer? I can't do it here.
I'm
Okay,
sorry,
okay. I see it.
can't.
Don't worry. I think I can do it now. All right.
Yeah,
Yes, we have
it's
it
showing.
now,
It's
right?
already up.
Okay, that's
Yes,
fine.
it's up.
So, come September 22nd of September, we'll be having IFRS 9 financial instruments. So, which goes for 10,000 naira. So I want us to log in and get the best out of IFRS 9. We promise simplicity, as our name is, to make it simpler for us. So thank you very much. The flyer will be sent to our individual box for us to keep the dates and also to enroll for it. So thank you very much for staying to the end of this training section, despite the internet and the network issue. I really appreciate your stay. Thank you very much. Christy, please, you can take over, please. And don't forget, there's another thing concerning the training. Sorry.
Thank you, Toby. Thank you so much. I can see one hand up, but the name is not showing. It's just saying rename your device. Please, you might have the floor. There is a hand up there. Kindly unmute yourself, please. We have to hands now.
Good afternoon, please.
Good afternoon.
I don't know why my name is not showing. I'm Joshua by name.
Okay.
I actually put up a question on the chat box requesting that can we get a video or the record of this class when it's free, because of some of us that maybe we need to go through it to quickly grab the full knowledge. Based on slow learners like myself, we just need to get the video again so that at least you can grab the knowledge very well. Thank you.
Thank you very much. Christy? Christy? Christy, are you there? Yes, as usual, if you attend the last class, we send the videos, both the video, the slide, even the questions to you. So definitely you should get those materials and recording as well. Yeah. Okay. Another hands, Chima. Chima, please can you unmute yourself and have the floor?
Hello, good evening.
Yes, good evening.
I'm even surprised my name is coming up as Chima. My name is not Chima. I guess it's the
sorry.
they admit that I did it that way. My name is actually Dayo. I think the first speaker had talked about what I wanted to ask, which I have also dropped on the chat box. But the second thing is the next training, which is the IFRS 9. You mentioned you display the leaflets, so to speak. Is it the 22nd of, sorry, I didn't even bother to check, maybe because I was using my phone. Is it going to hold on Sunday too? I would have preferred that those trainings hold on Sunday because my engagement on Saturdays are always very tight. So I wouldn't want to miss out in such sections. So is it still holding on a Sunday? Just
yes, it's on Sunday by 1 p.m. It's on Sunday too.
Oh, perfect.
Because we've already analyzed, we've done a survey that people are most available on Sundays.
Yeah, that's perfect.
And all our trainings will be on Sundays.
That's perfect. That's perfect. I will also, I don't know, you were trying to display your phone number on one of the slides. Someone asked a question. Is it something that one can reach you? Can we hit your DM personally? I don't think it's okay.
Yes, it's there. It's on the screen. Are you seeing my screen?
He's trying to, okay, I can see it now.
Yes, that is my contact. That is our contact. And you can also email us at questknowservices@gmail.com.
Okay,
let me quickly keep in this. We also conduct trainings both at the zonal level and the district level. And also for companies on data analysis and data cleansing, Excel from the basics to advanced level. So you can contact us if you need any of our services on that line 070-7522-7448. And you can also send an email to us at questknowservices@gmail.com.
Are you based in Lagos?
Yes, I'm in Lagos.
Yeah, she's in Lagos. So thank you so much, our facilitator. We really appreciate another time of sharing from your wealth of knowledge with us. And I know that everybody that attended today's webinar has so much to take home. And to our participants, I really want to appreciate you for your time. Thank you so much for paying attention. Thank you so much for not disrupting this gathering. So until another time, I look forward to see you all where we'll be sharing knowledge again. Thank you and bye for now. And don't let us forget that Toby has been giving it to us on a platter of gold, like she has been giving us, she has been sharing her knowledge with us without us paying. So I would like us to encourage her with this one that will be coming up by September. So let us register massively in order to encourage her. Thank you and God bless you all.
All right, thank you very much. Thank you,
Thank you. Bye.
Thank you. Bye-bye. Enjoy the rest of your day.
Yeah.
All right, bye-bye. Thank you.
Bye, everyone.
Yes, bye-bye.
Bye-bye. Thank you so much, Toby.
Bye-bye. Thank you.
Thanks for staying to the end.
Thanks for staying to the end. Thank you, Toby.
Thank you.